Hey guys, how's it going? It's Andy from Magoo Investing. Today I'm going to be talking about probably the most common question that I get when it comes to how do I get started investing in the stock market? Because for most people, when they are trying to figure out, the way that their mind goes is they want to, I want to make money. But the first thing you need to figure out is what type of account should I be setting up? What are the benefits? What are the cons to having the various types of investment accounts that you can open? And then you start focusing on which stocks you want to buy. So in today's video, I'm going to be talking about what it means to be opening these type of investment accounts. I'm going to talk about the two main kind of umbrella terms of investment accounts. You have the normal brokerages, which is kind of the normal stuff that you'd see with like a Robinhood. Then we're going to be talking about the retirement accounts. These are stuff that isn't as well known to the common person. You can go in and open a Robinhood account within 5 minutes if you get accepted early enough. Retirement accounts take a little bit longer to open, but there are a lot of benefits, and I'm going to be laying that out in today's video. So in today's video, the whole point is I'm going to be talking about what each of these individual accounts mean. I'm going to be talking about the three most common retirement accounts and explain where I decide to put my money. I'm not giving financial advice, but this is just my explanation of where I decide to put my money, because it's a very complex decision. I've been talking about this with my roommate that it's not as easy as, I have this amount of money to invest, I should just put it all into this account. There are more different types of accounts out there, stuff like a 529 that's used for a child's education, but for most people, they're not needed yet, especially if you're trying to learn about the stock market on YouTube and not talking to a financial advisor. But overall, there are three main differences between retirement accounts and the standard brokerage accounts. The first one has to do with contribution limits. Say you want to go and open up a Robinhood account today. You can put as much money as you have and are willing to put in there at any given time. So say for some reason I find 100 grand on the ground. I can put that all into that Robinhood account if I really wanted to. So with standard brokerage accounts, there are no contribution limits. You can put as much as you want. However, retirement accounts have contribution limits that restrict how much you're allowed to put into that account per year. And I'm going to talk about that when we talk about the individual retirement accounts. But when you look at the differences between the standard accounts and the retirement accounts, the first main difference is contribution limits. The second difference has to do with taxes. In a normal investing account, you have two situations for the different types of taxes you're going to be paying on your investments. First, you have the situation where you buy and hold for more than a year. This gets put into a different type of tax bracket than your normal income bracket. These are called the long-term capital gains rate, and is lower than your normal income bracket. And the whole benefit of it is that you're going to be holding for longer, and they're going to be paying less on the gains that you make on that. But if you hold for less than a year, it just gets taxed at your normal income bracket, and you have to declare it as income on your taxes during the year. On my main channel, I talk a lot about selling options, and this is a short-term income. So I would have to declare that on my taxes. The way that you get around that is the reason that retirement accounts are so great, and the main reason why you would consider opening one in the first place has to do with the tax benefits, which we'll talk about when we go into the retirement accounts. But the second main difference has to do with taxes. When you have a normal account, you have the normal income that you would pay if you hold something for less than a year. And if you hold for longer than a year, you do not pay taxes until you sell, and you pay it at a lower rate than your normal income bracket. The third thing that you need to know about the difference between a standard investing account and a retirement account has to do with the access you have to your money. If you have a Robinhood account, you can take it out at any point. There are no restrictions on how much you can put in, and there are some restrictions on how fast you can take things out, but there's no restrictions on the total amount that you can take out at any given time. When it comes to retirement accounts, there are restrictions on how much you're allowed to take out at any given time and when you're allowed to touch it. In general, you're not able to access it without a fee until you hit 59 and a half years old. There is something called the rule of 55, but that 55 refers to the age of 55, so most likely that is not applicable to anyone watching this video. But if you do have an emergency, with the pandemic, they allowed people to go into their retirement accounts and take a certain amount of money out with no fee. But during a normal year, if you have to, based off of any type of emergency, you're going to be paying a 10% fine on the money that you take out. So those are the three main differences between retirement accounts. First has to do with contribution limits. With a normal investment account, there are no contribution limits. Retirement accounts are capped based off of what type of account you set up. Number two has to do with taxes. There are the two different brackets that you could be paying for a normal investment account, depending on if you hold for longer or shorter than a year. And retirement account, we'll talk about the taxes in a second. And then number three has to do with the access to your money. With a normal account, you can take as much out or keep it in for as long as you want. There are specific restrictions that are put in place for retirement accounts having to do with being 59 and a half, and if you do have to take money out of the account, you do pay a 10% fee. So now let's talk about the interesting stuff that has to do with the retirement accounts, because based off of the kind of overview that I've given on the two different types of accounts, it may seem beneficial just to have a normal account, but retirement accounts and the tax benefits are so good. That's the whole reason why it's much easier to build wealth in a retirement account than in any other account. So let's talk about the three different retirement accounts. You have 401ks, you have IRAs, and you have SEP IRAs. 401ks are usually created with an employer. You do have the ability to make one on your own called a solo 401k, but I'm not going to be talking about that in this video. Maybe I'll talk about that in a separate video. An IRA is an individual retirement account and can be opened by anyone without an employer. There are some restrictions on you have to make a certain amount of money during a given year, but for the most part, anyone can open an IRA. Then you have a SEP IRA, which is a simplified employee pension that are used for business owners and freelance workers. So for myself right now, I am not working for a company, but I'm making YouTube videos, so that I do count as a freelance worker. So in theory, I could create a IRA, because anyone can, and a SEP IRA. There are scenarios where you could have all three, a 401k, an IRA, and a SEP IRA, but there are some differences between these accounts. So let's talk about the first main difference, which has to do with contribution limits. With a 401k, is done through the employer. And one of the benefits of having a 401k through an employer is that in some situations, you do have a match. What this means is if I put $5,000 in, the company will match up to a certain amount. And that's all depending on what type of company you're working for. The contribution that's matched by your company does not count towards your contribution limit. So for a 401k, the contribution limit now for 2021 is $19,500 a year. Then when you talk about IRAs, you have $6,000 a year. So this is much different because anyone can do it and it's not required to be through an employer. And then you have a SEP IRA, which, as I mentioned, has to do with business owners and freelance workers. And you can put up to 25% of your net earnings up to $58,000 in 2021. So those are the differences between contributions. But the main benefit of having a retirement account comes with part two, with paying taxes. The two types of retirement accounts, you have traditional and Roth accounts. Both have tax benefits, but some are much better than others. With a traditional account, you have the benefit of putting your money in before you get taxed. What this means is you can take money directly out of your paycheck and have it go into your retirement account. What that does is you are not paying taxes, so you're able to put more in compared to if you are putting in post-tax. Also, it lowers your net income, so you're going to be potentially paying lower taxes overall because that money's being taken out. You have less income coming in. It's going into that retirement account. But it is not as good as a Roth account. Money put into a Roth account has already been taxed as income. So it's the same money that's sitting in your bank account. It's already been taxed in theory. When you put it in, that money is allowed to grow tax-free. So if I put in $1,000 a year for 40 years, that's going to be $40,000 of contributions. The difference between a Roth and a traditional is that the money that's made off of that $40,000 has no taxes associated with it. So if we're going to be doing the 10% a year that I try to shoot for, and is what has been returned by the S&P 500 for the past 100 plus years, that will result in $532,000. You already paid the tax on the $40,000, but all of that growth is tax-free, so you get the benefit of that. And for young people like myself, having a Roth account is so much more beneficial because that money is allowed to grow without having to pay taxes on the growth. While it may seem beneficial to lower your taxes now, if you're thinking long-term and thinking about, this is a retirement account, having the growth tax-free is so beneficial. And then there are some differences between when you're allowed to access it, but in general, 59.5 is when you can take it out. So I talked about the basics of what all these accounts are. What accounts should be using? It's complicated, just like pretty much anything when it comes to money. Retirement accounts have tax benefits, but you aren't allowed to access them without paying a penalty. So you need to determine what your long-term and short-term goals are. My long-term goal is to retire comfortably. My short-term goal is to have enough money saved up to buy a car. So I have two different goals that I'm working towards, and I need to determine how much I should be putting into each one at any given time. In general, it's beneficial to put money into a retirement account because it's going to grow over the long term. But you need to make sure that you have enough going into your short-term savings that you can reach your short-term goals. Because as I mentioned, once you put it in, you can't take it out without penalty. So in theory, the flow chart of places to put money for retirement accounts, first, you take whatever match you have from your job with your 401k. In theory, this is just free money. Even though the gains on it are going to be taxed, the money going into it is basically free. So you put money into the 401k up to the match. Then you max out your Roth IRA with up to the $6,000 if possible. If you have money left over, then you can go to a Roth 401k because, as I mentioned, the Roth is much better than the traditional 401k. And then if you have a SEP, that's the next place to go. From everything I could find, you are not allowed to have a Roth SEP. So, it's beneficial because you can put more money away up to the, $58,000, but it's going to be paying taxes on the money that you make off of it. So in short, you prioritize the match, then you max out the Roth, then you put as much more money in as you can. And if you can have a SEP, you can put a lot of money into it at any given time. So there's a lot of things to consider when deciding which accounts you want to be funding. There's not some general rule that people follow. You really need to determine what your short-term and long-term goals are, because say my goal in the next 5 years is to buy a house, I'm going to be needing to save more aggressively in the short term compared to saving for retirement, because it's not going to help me buy a house if I'm putting, $1,000 away a year if I'm trying to put a down payment down on a house. So you need to kind of determine what your short and long-term gains are, and I cannot make that decision for you, but it is important to know the benefits and cons about having these individual accounts, because there are pros and cons to all of them. There's not one that's the single best. Yes, you could say the Roth accounts are fantastic when it comes to overall growth, but you do have the downside that you're not able to access them until 59 and a half. So this is a very complex thing. We're going to be talking about it more in the future, but yeah, you need to determine what type of accounts you want to be putting your money into before you're picking what individual stocks you want to buy. So thanks for watching. I'm hoping this video was informative, and I will see you guys in the next episode.